Hi, welcome. Welcome back. And this lesson, we're going to look at position sizing. Position sizing is the part of your trading system that tells you how many shares to buy or sell per trade. If you remember, what makes a successful trader? 60% comes from psychology, 30% comes from position sizing, and 10% comes from the actual strategy itself. In other words, the entry rules or the exit rules. So I'm going to go so far as to say that position sizing is even more important than the entry rules and the strategy you're using. In fact, research has shown that even if you were to take random entries in the market, flipping a coin, just buying or selling, but if you get your position sizing correct, you can make money as well. Now, conversely, there are some people who know everything about fundamental analysis. They know everything about technical analysis, how to read charts and support and resistance, but they can't profit consistently. And the reason is because they lack one of the most important pieces of the puzzle. You got it, position sizing. And that's how important this chapter really is. So let's dive right in. So position sizing is important because it helps you to determine three things. Number one, how many shares to go long and to go short on a particular trade. Second, it helps you to define your risk per trade, which has to be consistent when you're trading, and the overall risk to your portfolio at any one time. Finally, more importantly, it helps to define your expected returns on your portfolio. So if you're trading, how do you know how much money you're going to make? A month, a year? I mean, there's no way to know for sure, but with position sizing, we can more or less calculate roughly what our returns are going to be. And we don't leave it to chance. All right? So position sizing is really about calculating the size of our position. How big a position do we take in any particular trade? Now, there are specific steps to go through, and here are the steps. Step one is before you take a trade, you have to look at your capital, or we call it your net liquidation. When you open an account with a broker, in one of the areas under your portfolio, you can see net liquidation. That tells you the value of your cash and your shares which you're holding added together, or the value of your account. Okay, so for example, if you open an account and you put in $10,000 and it's all in cash initially, that's your net liquidation, $10,000. Step two is you have to determine your risk per trade before trading. Your risk per trade refers to the maximum loss that you can take per trade. This is the maximum that you can lose if your stop loss is hit. This loss should never be more than 1% to a maximum of 3% of your capital or your net liquidation at any one time. So in other words, we never risk more than 1% to a maximum of 3% of our capital on any single investment or trade. So for the purpose of this discussion, let's take, for example, we take a risk per trade of 1%. And I suggest if you're a beginner, always risk 1%. Now, if you're risking 1%, you have to be consistently risking 1% in any trade you take. No matter how confident you are on a trade, you always risk 1%. If you want to eventually upgrade your risk to 2%, then you have to stick to 2% all the way. You can't risk 1% in one trade and 2% in another trade. It doesn't work that way. It's got to be consistent. Step three, we calculate the number of shares to buy or to sell by using this formula. And the formula goes this way. First, we take our percentage risk per trade, which in this case will be 1%, right? Multiplied by our capital or our net liquidation, in this case $10,000. And we divide it by the risk that we are taking per share that we are trading. So let's look at an example of going long. So let's imagine you see a trade setup. You want to go long on Bank of America at $8.60. That's your entry price, okay? And your stop loss is placed at $7.90. Now, how do you know where to place your stop loss? That all depends on the specific strategy you're using. So in the coming videos, you're going to learn different strategies like the Bollinger Mean Reversion and capitulation, for example. So in those strategies, I'll teach you where you place the stop loss. It is usually placed just below the candlestick, okay? So for this example, let's imagine our stop loss is at $7.90. And we have to determine our profit target. In this case, is $10. how do we know where to place our profit target? Well, our profit target must be placed at a price where we can profit at double our risk. And I'll explain in a short while. So let's see how this works. So in this case, I'm going to buy Bank of America at $8.60. And I place my stop loss at $7.90. Again, depending on the strategy, you will know where to place a stop loss. Okay? So what is your risk per share? Your risk per share in this case is 70 cents. Because 860 deduct 790 is 70 cents. So in other words, for every one share you buy, you're risking 70 cents. Because if it hits the stop loss and you sell for a loss, you're losing 70 cents per share. Follow? Great. So the distance between the entry and the stop loss is called 1R. And R stands for risk. Okay? So we have to place our profit target at double that distance. So what is 2 times 70 cents? That's right, you got it, 140. So 140 plus our entry price will be $10. Okay? So how many shares do we go long? Well, once again, let's look at the formula, right? So what we do is we take our risk per trade, which is 1%, right? 1% risk per trade, multiplied by our net liquidation. In this case, we are starting with 10,000. So 1% multiplied by 10,000 is $100, right? It's $100. So what does this mean? This means that the most that we can lose is $100 if we are wrong on this trade. Okay? Our total risk is $100. Now, what's our risk per share? Our risk per share is 70 cents. So how many shares can we buy? Well, the answer is you take your total risk, which is $100, and divide it by the risk per share, which is 70 cents. And that gives you 143 shares. So now you know exactly how many shares to go long. So what's your position in Bank of America? Your position will be $8.60, that's the entry price, and multiply that by 143, and your total position size will be $1,229.80. Okay? So in other words, out of $10,000, you have a position of 1,200 in Bank of America. Now bear in mind, your position is not your risk. Although we buy $1,200 of Bank of America shares, that's not our risk. Because we can't lose 1,200, right? Our risk is $100. Okay, our risk is $100 because that's where we place our stop loss. Got it? Great. Let's look at another example right now. So imagine this time you want to go short. You see a stock that's on a downtrend, you're going to go short. And let's imagine that we're going to short a stock known as JCPenney. Okay, so we're going to enter the short position at 1650. We're going to sell it at 1650. If it goes down, we make money. If it goes up, we lose money, right? Okay, so if it goes up, we have to cut loss somewhere. So we're going to place a stop loss at $18.60. Again, where do you place a stop loss? You will learn it in the specific strategies that will follow, right? Cool. And we need a profit target. So if it goes down to a certain level, we need to exit and take our profits. So in this case, our target profit is at $12.30. So remember those figures, okay? So let's take a look at how we'll set it up, okay? So in this case, we're entering a sell order at 1650. Our stop loss is at 1860. Great. So what's our risk per share? Our risk per share in this case will be 1860 minus 1650, that's $2.10. So for every share that we short, if it hits our stop loss and we sell at a loss, we lose $2.10 per share. Okay? So that's our risk. Now our return has to be double of that. So our return has got to be, that's right, 420. Take 210, multiply by 2, you get 420. So you take your entry price, 1650, minus 420, that gives us a profit target of 1230. At 1230, we exit, take our profits. So we're risking, again, 1R to make 2R. So in this case, how many shares do we short? We use the same formula. right? So again, we take our risk per trade. What's our risk per trade? 1%. Always be consistent, okay? So we take 1% multiplied by our net liquidation. Now, what's our net liquidation? Let's imagine we started with $10,000, right? Okay. Now, when we bought Bank of America, okay, if Bank of America did not go up, it did not go down, it's at the same price, what's our net liquidation? That's right, it is still at $10,000, okay? But out of the $10,000, we have got about 8,000 plus in cash and 1,000 plus in Bank of America shares. But the net liquidation is still 10,000, follow? So we always risk a percentage of the net liquidation, not of the balance cash, not of the balance cash. Okay? So imagine if I bought Bank of America and Bank of America went up and hit the profit target and I got a profit. I take a profit, right? So my 10,000 would now be more. It would be maybe $10,200, for example. Okay? So now my net liquidation is 10,002. So if I buy a second share, I will risk 1% of that larger amount of 10,002. But if I bought Bank of America and it went down and it was a losing trade, what happens? My 10,000 now becomes 9,900, right? So my net liquidation has shrunk. So if I buy a share now, I risk 1% of 9,009. So as you trade and your capital grows, notice you still risk 1%, but of a bigger amount. So this compounds your capital up. But at the same time, if you have losing trades and your capital shrinks, you risk 1% of a small amount and you cut your position size down accordingly. So that's how it works. Okay? All right, cool. So let's imagine you bought Bank of America. It has not moved up or down. So your capital is still $10,000. Okay? So you risk 1% of $10,000. And again, what's your risk? $100. Okay? So your risk is the same for JCPenney. Yeah? Now, what's your risk per share at this time? Your risk per share is $210. Okay, so your total risk is $100. Each share that you short, you're risking $2.10. How many shares can you short? That's right, take $100 and divide it by the risk per share. That will give you -48. So a negative sign means sell. Okay, so now you know that you're going to sell 48 shares of JCPenney. All right, so 1650 multiplied by 48 shares, that's $792. So we're going to sell $792 of JCPenney. So notice Bank of America, we have got a bigger position of 1,002. JCPenney, 700, smaller position, but the risk is always the same, 1%. So like I said, your position is not your risk. Okay, so to help you to calculate your position size more efficiently, you can download the position sizing calculator on the resource section of the website. So here's how it works. So all you got to do is to key in the boxes in white, and the ones in red will have the template formulas that will give you the result you're looking for. All right, so do not touch the ones in red, only key in the boxes in white. So for example, we want to go long on Bank of America, right? So what you do, key in your current account size, also known as your net liquidation. So in this case, it's 10,000. Again, it could be anything from 50,000 to $1 million, for example, whatever it is, right? Okay, so it's going to be 10,000 in this case. Cool. Next, we key in our risk per trade. So my suggestion again is to risk 1%. Okay. Next, key in your entry price, your stop loss, and your target price. For Bank of America, our entry price was $860. We place a stop loss at $790 and a target price of $10. Okay, so if you key this in correctly, you should see a 2 over here. This is your return risk ratio. So in other words, we are risking 1 to make 2. Okay, your risk per share is 70 cents and your potential profit per share is 140. So it's 1:2. So you want to see that. Okay, and over here it tells you the number of shares you need to buy in order to get that result, which is 143 shares. So in other words, if it's a winning trade, you will get a 2% gain on your capital. If it's a loss, it's a 1% loss of your capital. All right. So how about the second example, JCPenney? So for JCPenney, we are going short. All right. So same thing. Our net liquidation is 10,000. We're risking 1%. In this case, if we're going short, our entry price was 1650. In a short, your stop loss is always above your entry price. So in this case, our stop loss was at 860. And our target price was 1230. So you can see again, we are risking 210 to make 420. It's a 1:2 risk to return. And number of shares would be a negative 47.62, or round it up to 48. Okay, so we know that we got to sell 48 shares of JCPenney. And that's how you use this calculator. So now let's take a look at how many positions can you have concurrently, or how many positions can you have at one time. It depends on two things. The first thing, it depends on how much cash you have left to take on new positions, because every time you take on a new position, it takes up cash from your portfolio, right? Number two, it's determined by what is the total risk that you want to expose your portfolio to. Because remember that every time you take on a trade, you're risking 1%. So if you take on 5 trades, you're taking a cumulative risk of 5%. Right? So let's take a look at an example over here. So let's imagine that in your first trade, you are going long of Bank of America, and you saw earlier on that we have a position of 1229. Okay? So if you buy the shares in cash out of $10,000, $1,200 is used up to buy Bank of America. So you have got about $8,700 left to buy other shares, right? And when you buy Bank of America, you're risking 1%. And you have the potential to make 2% if it hits your target price. Now, later on in this video, I'm going to show you that you could, instead of buying the actual shares, the underlying shares, you could buy a contract on those shares. And it's known as CFD. CFD stands for Contract for Differences. Now, if you're not a US citizen, you can buy CFDs. If you are a US citizen, you can't buy CFDs. And the reason they don't allow CFDs for US citizens, my guess is because if you have that, it would kill the options market, because it's way better than using options. There's no expiry date. And CFDs allow you to take on a position by just putting down 10% in margin, or a so-called 10% deposit. So in other words, if instead of buying Bank of America, I bought the Bank of America CFD, I will not have to use $1,229. I will only have to use 10% of that position amount, which is roughly 10% would be $123 in deposit, which means out of $10,000, I only require $123 of cash to be used up to hold this position. So in a sense, I'm kind of like putting a down payment of 10% and borrowing 90%. Of course, there is an interest financing charge that is charged on that, which is roughly about 4% interest a year. So if you're doing a swing trade of a few days, the interest is pretty insignificant. All right? So let's move on. So in the second case, we went short on JCPenney. Now, when you go short, you're selling the shares. But even then, you still need to take up cash to hold the position. So if we sell $792 of JCPenney, usually the broker will require you to put in an additional 50% to hold the position as collateral. So 50% of 792 is roughly about $400. In other words, you need $400 of cash from your account to be used to hold this position. But again, if you use CFDs, you only need 10% of 792, which is $79. So CFDs allow you to take positions with very little cash, and hence you can take more positions. All right? So say after that you take a long on McDonald's, so that's 2003. You go long on Apple, that's 2006. Okay, so again, if you are buying the shares directly with cash, you find that after taking 4 to 5 positions, you would use up most of your cash. So out of $10,000, you may only have $1,000 left. So you can't take on any more positions. All right, so let me repeat that. If you buy the shares with cash, you should only be able to take 4 to 5 positions at the maximum. That's it. Okay. But if you use CFDs, which I'm going to talk about more later on, you could take up to 10 or 20 or 30 positions at one time because it uses very little cash since you only put in 10%. But do you want to take 30 positions? No, you won't, right? Because every time you take a position, you're risking 1%. Remember that, okay? So my suggestion is that at any point of time, you should not be risking more than 10% to your portfolio. You should not expose your portfolio to more than 10% of risk. In other words, if you're risking 1%, you should have no more than 10 outstanding positions at one time. If you're risking 2% per trade, have no more than 5 trades. Okay, so always take your total exposure at 10%. Why? Because in the worst case scenario, and if you're going all long and suddenly the market crashes because there's a war, for example, what happened, right? All your positions may hit their stop loss and you may lose all the trades. So you always want to keep the maximum at 10%. So in this case, our total risk is 4%, that's fine. And again, if they all hit the stop loss, we lose 4% of our capital. If all 4 trades are winning trades, we will get an 8% gain on capital. If we get a 50% win rate and 2 of them win and 2 of them lose, what happens? That's right, we lose 2%. Here, for example, we lose 2% and we win 4%. Our overall net win is still a 2% gain on our portfolio. So the beauty of doing this is that even if you're right half the time, or even less than half the time, you are still profitable because your average win is double your average loss. Another thing to bear in mind is that when you take concurrent positions or multiple positions, ensure that they are not correlated. In other words, if you buy 5 stocks at the same time, please do not buy all 5 banks. Bank of America, Goldman Sachs, Citigroup, JP Morgan, Morgan Stanley. Why? Because stocks within the same sector tend to move together, right? And if one of them wins, all of them will win. If one of them loses, all of them will lose. So you have to diversify between different stocks in different sectors. So why is it important to keep our total risk exposure to 10%? Again, like I mentioned, the reason is because in an event of a black swan, right? Suddenly there's a war between the US and China, or North Korea launches a missile and the whole market crashes, and all your long positions get taken out. The worst that can happen is you lose 10% of your capital. Now you can see from this chart that if you lose 10% of your capital, we call it a drawdown of 10%. To get back to break even, your balance capital has to gain 11.11%, which is pretty simple, okay? If you have a loss of capital of 20%, to get back to break even, your balance has to gain 25%, okay? If you get a 50% fall in capital or drawdown, to get back to break even, your balance has to get a 100% return. And of course, if you lose 100%, game over, you're broke, right? So one of the most important things in trading, or investing for the matter, is to preserve your capital, to protect your capital, to live to fight another day. Okay, that's the reason why. So never bet the farm. Yeah. So we have seen how to calculate risk. Now let's look at what is the potential return or profits you can make if you follow your trading plan. To do that, let's go back to this formula we've learned earlier on. It's known as expectancy formula, or our expected profit per trade. So recall, this is the formula that we use. Our expected profit per trade is percentage win multiplied by average win, and we deduct our percentage loss multiplied by our average loss. Okay. Now, if you follow the strategies that you're going to learn in this program, your strategy win rate should be anywhere from 50% to 80% win rate, depending on the month. All right, there are certain months you may get 80% win rate, even 90% sometimes, but certain months your win rate may drop to 50%. So I'm going to take a rough conservative average of a 55% win rate, being really conservative here. So that means on average, out of 10 trades you make, you're going to win 5.5 of them, okay? And 4.5 of them you're going to lose. That's the way trading is, all right? So let's calculate based on this, what can we expect to get in profits? So notice that with a $10,000 account, you're risking 1% per trade. So your risk is $100. And if you get a winning trade, your return is double of that, it's $200, okay? Now again, of course, in reality, your $10,000 account will grow to 20, 30, 40, 50K over time, which means your risk will be bigger, so will your return. But for simplicity, let's just take it as $100 and $200, okay? So if you plug it into the formula, what do you get? That's right, you get this. So 55% of the time, you will win $200, and 45% of the time, you're going to lose $100. So if you do the math, that equates to $65 per trade. So what it means is that when you begin trading, on average, you get wins, you get losses. You win 200, you lose 100. But on average, if you even out the wins and losses, you get an average of $65 per trade that you take. So what does that mean? That means on average, if you do 20 trades a month, 20 multiplied by $65, that's $1,300 in profits a month. So $1,300 out of $10,000 is about 13% return a month. That's pretty okay for a win rate of 55%. Now, one of the most important things I learned in trading is in order to be emotionally detached. So when you win, you're not too happy. When you lose, you're not sad. You just follow the system. Is to not think in terms of dollars. Because money is a very emotional topic for most of us, right? I lost $100. Damn, I made $200. Wow. Don't be emotional. So instead of thinking about money, think in terms of R multiples. So from now on, we're going to use R multiples. Now, what's an R? Okay. Recall that 1 R is a unit of risk. And 1 R refers to the maximum risk per trade, which is 1%. Or eventually 3% when you are confident enough. But for now, let's get 1%. So when we get a losing trade, we never think that, I lost 1%, I lost $100, right? I lost a TV set. No. We think we lost 1 R, okay? And when we win 2 R or more, okay? So if you think in terms of R's, let's plug that into our expectancy formula. So in this case, you'll be 55% win rate multiplied by a 2R average win, and a 45% losing rate multiplied by the average loss of 1 R. So if you do the math, you get 0.65 R per trade. So again, that means that on average, every trade that you take over a large sample size will give you about 0.65 R. As long as that figure is positive, just like the casino, right? The casino never knows when they're going to win or lose a hand. But the casino knows if they keep playing again and again and attract players to the casino, they always win in the end. Why? Because they have a positive expectancy. And the same goes for you as a professional trader. So this means that, again, on average, if you take 20 trades a month, and each trade you're getting 0.65 R, you're going to net about 13 R a month. Okay, so what does 13 R mean? Again, if you're risking 1% per trade, a 13 R return refers to a 13% return on your capital, which is what we got earlier on. Now, if you eventually risk 2% per trade, your R is 2. What happens now? 13 R translates to 26%, because 1 R is now 2%. If you risk 3% per trade, 13 R would now equate to 39%. So the bigger the risk per trade, the bigger the returns that you get. Now then you may say, why don't I just risk 10% in that case, or 20% per trade? I'm going to make millions, right? It's the reason why. Because we don't win all the time. We get losses, right? And sometimes the losses may come in a row. Sometimes you may get 4 or 5 losses in a row. That's possible. So even with a win rate of 60% win rate, you don't always get 6 wins, right, and 4 losses. And 6 wins and 4 losses. It doesn't always come that way, or win and a loss and a win and a loss and win and win and loss. It may be many losses in a row. So you have to understand that if you risk, for example, 1% a trade, and you get 5 losses in a row, that will equate to a 5% drawdown on your capital, or 5% loss on your capital. And for most people, psychologically, that's not a problem. They can carry on trading. But if you risk, for example, a crazy 10% per trade, and you get 5 losses in a row, what's that? That's right, that's a 50% fall in your capital. And to most people, when they lose half their money, their fingers starts to shake before they can press the next button on the next trade. They start to lose their shit, and they get emotional, right? So we always want to risk an amount where even if we get 5 to 6 losses, it doesn't affect us emotionally. And only when you can trade in a detached way, logically, will you definitely succeed in trading. Now let's take a look at this trading simulator, which you can again download on our resource section on our website. And this is a trading simulator to show you the kind of results you can expect when you trade the different strategies. So let me orientate you to this, yeah? Alright, so this is running on an Excel template. So let me zoom in. Now, the first thing is to key in the boxes in white. These are the variables that you can control, and it will churn out the results in yellow and red. Okay? Okay. So let's assume that the strategy you're trading has an average win rate of 55%. Again, let's be really conservative. Again, on good months, you may get an 80% win rate. On certain months, you may get a 50% win rate, but let's just put it at 55%. Okay. Now, notice that there is something called the simulated win rate over here. All right, where although my win rate is 55%, but it simulates 47%. Okay, now if I key this in again, notice that this changes, right? Every time I key this in, this would change. Why? Why does this happen, right? This is based on a random number generator for Excel. So let me give you an example, right? If you take a coin and you toss a coin, what's the theoretical win rate of getting a hit? It's 50%, right? That's a theoretical win rate. But if I toss it 100 times, will I definitely get 50 hits and 50 tails? No, I may get 55 hits and 45 tails, or 55 tails and 45 hits, or 60 hits and 40 tails, or whatever. So the point is that there's always a short-term random luck factor to it. That sometimes over 100 trades, you may get more wins than losses than what your strategy is supposed to do, right? Or sometimes we get more losses than wins. So this is a simulation based on 100 trades of random numbers. Okay. Now, on average, the strategy that you're going to learn, we're going to have about 20 trades a month. So in other words, you should be able to do 100 trades in about roughly 5 months. Okay, so this is over a 5-month time period. Now, so we're going to leave it at 55%. And again, every time we do that, we will get a different simulation. Yeah, I mean, you can do it 100 times and you can see 100 different simulations. Okay, now for the losing R multiple, we're going to set it at 1 and 1. So this is, so what we're saying is the minimum risk is 1R and the maximum risk is 1R. Why? Because we will always exit when it hits our stop loss. Now granted, sometimes when it hits the stop loss, we may not lose the exact 1R. We may lose more than 1R because sometimes when the market moves really fast, we may not get filled at the exact price. So we may sometimes even get a 1.1R loss. So we're going to put 1 to 1.1. Okay. Now for our winning trades, we're going to put a minimum win of 2 and a maximum win of 2. Now you will definitely get at least a 2R win because we usually use a limit order when we take profits. In other words, we will not take profits unless we get at least 2R. Okay, so this would be something that's fixed. Next, put in your risk per trade. So again, we can begin with a risk per trade of 1%, key in 1%, and put in your starting capital. So let's assume your starting capital is 10,000. Let's key in over here, 10,000. Enter. Okay, great. So you can see that based on a win rate of 55%, when actually it's 53%, okay, based on a risk of return of 1 to 2, and based on a 1% risk per trade, your 10,000 starting capital should grow to $17,000 over 100, over 100 trades. Okay, so that is a compounded return of 75% on your capital over 5 months, right? And that's based on a 55% win rate. Now, on the right, you can see what we call drawdown. So remember, a drawdown is a loss of capital, a fall of capital as a result of losing trades that are inevitable. Okay, so in this case, you can see based on this simulation, we have a drawdown of minus 6.7 R. Why? Because we may have gotten 6 to 7 losses in a row. Now, if you go to the specific trades, you can see over here, you can see that there will be times when you've got many losses that come in a row. Sometimes they may even come, like in this case, 6 to 7 losses in a row. Okay, so when that happens, you have a drawdown. You can see that because we are risking 1%, our drawdown is minus 6.7%. So as your capital grows from $10,000 over here to $17,000, it is not a straight line. There will be ups and downs. There will be drawdowns along the way. And that is how trading is. Okay. Now let's look at a few more scenarios. Now you can see, for example, that if my win rate goes to, say 60% win rate, what happens to my return? It becomes a lot larger, obviously. Okay. Now, if my win rate drops to, say, 50%, okay, and let me do it in such a way that the simulated win rate is 50% as well, or lower. Let me do it a few times till I get 50% or less. Come on. All right, great. So you can see in this case, my win rate drops to 46%. In other words, I'm wrong more than I'm right. Okay? But you can see even in this scenario, my total return is still 41% over 100 trades. Or 41% return in 6 months or 5 months. Okay? So even if you're right half the time, you're still making a much better return than putting your money in the bank. Why? Because the secret to the strategy is you're risking 1 to make 2. So you never ever want to compromise on those things. All right? So let's go back to 55%. Okay. Now you can see again, if you were to change the risk per trade to 2%, what happens to your return of capital? It increases. If you put it 3%, right, you can see that your compounded return becomes really big, but at the same time, your drawdown may increase as well. Okay. So the more you risk, the higher your return, but the bigger your volatility in your capital. All right. So let's go back to 1% over there. What's important to note is that now, if I would ask you, would you mind getting a 79% return on your capital in 5 months? Right? Most people say, yeah, I love that. That's fantastic, right? Yeah, most people say that's what they want. But in order to achieve that, you must be willing to go through the journey of doing all these trades, all these 100 trades. About 20 trades a month, it will take you about 5 months to complete all these trades. And you have to understand that, again, there will be times when you will go through a string of losing trades. You can see from trade 7 to trade 16 what happens. You've got a whole bunch of losing trades, all right? Now let's imagine, for example, you start trading. And it so happens that when you start trading, you happen to capture this losing sample of trades where you do 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So let's imagine you did 10 trades. And it so happened that for your first 10 trades, you had 2 wins and 8 losses. Now, what's going to happen? Some people are going to freak out and say, oh my God, this strategy doesn't work. I only got 2 wins and 8 losses. I'm losing money. And guess what? They give up. They stop trading. All right? They get upset. Okay? But here's another example. What if, again, you had captured this sample of trades? Where, again, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You did 10 trades and you won 3 and you lost 7. All right? You know, some people, they lose their confidence. They stop trading. All right? But what if you started trading and you happen to capture this winning sample of trades? Where you did 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. You had a 60% win rate. Okay? Or how about this? What if you had captured this sample of trades, right? You did 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. You had 13 wins in a row. Imagine your first 13 trades, you had 13 wins in a row. How would you feel? You think, my God, it's so simple. I'm a genius. Let's risk 10%. Let's mortgage my house. Let's bet the farm, right? Don't do that, because the moment you do that, the losses will come. So my point is this. The wins and losses are distributed in such a way that you never know when you're going to get a win. You never know when you're going to get a loss. So when you get a win or a series of winning trades, don't be too happy. If you get a series of losing trades, don't be upset. Think statistically. Think the large number of trades. When you even out, you always make money. It is impossible to lose money if you keep following this system and detach emotionally from it, and you do really well. And to do that, you have to follow the position sizing rules we talked about.